Personal finance practice problem using OneNote. Overdraft protection costs calculation. Prepare to get financially fit by practicing personal finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side. We're in the Practice Problems tab, and down in the 4200 Overdraft Protection Costs Calculation tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Our presentations will also be in the text area with the same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got the information up top, calculations on down below. We're looking at the cost calculation for the overdraft protection. Let's give a quick recap of what the overdraft protection is. We're thinking about a checking account here. Obviously, when you're thinking about it from the bank standpoint, you might say, if you think about what they're giving you with a checking account, it's pretty amazing that you're basically, they're allowing you to track all your information in the checking account. They're keeping track of it for you. You're depositing, taking money out, and you have very little cost on it. How could they possibly do that? And remember, a lot of the financing of the institutions is in the format of they're holding on to your money or allowing you to pull in, deposit, and take money out, but they're only holding on to a portion of that money. They're loaning the rest out to make interest on it in the form of small business loans typically and mortgages. So that's generally how they're going to be making money when you put money into the bank. So note what would happen then if you have a negative amount that's in the bank. Then obviously you're not providing any money on which the bank can then provide loans for. So therefore you're going to have a problem there, right? They can't have people that have checking accounts in their bank with negative balances in them, because that defeats the purpose of holding on to the money and then having a reserve that they can basically loan out. So if you have a checking account and it goes negative, then they're going to have to basically generally charge you for the negative balances. Now, if you didn't have any overdraft protection and say you just had some automatic fees that you didn't really know about, you weren't tracking it too closely, and your account just goes negative, then there's a couple problems that could happen. One is that obviously the bank may not honor then the payments that should have been going out. And if they're supposed to be going out to important payments such as mortgages or such as credit card bills in particular, then that could cause a problem to your credit, right? Because then you're going to have a problem with the people that you didn't pay. They may get a bounced check, which is really lowers the trust in ourselves. That lowers our credibility with them, and it could lower basically the credit score as well. So there could be a high cost to having the checks be canceled and whatnot, and have a non-sufficient fund just in and of itself. And then, of course, they might charge us for the number of charges, or by charge that we have a non-sufficient fund. So not only that the payment doesn't go out, but we might end up paying money on the non-sufficient funds. And that could, if we have automatic payments, that could rack up quite quickly. So if we have overdraft protection of some kind, then hopefully our goal is to say, okay, if my account goes down, if I mess up somehow and I basically go below zero, I would like to have some protection on that so that you still honor the payments up to a certain amount, and then I pay, a set rate based on the overdraft protection that could be there. So you're safeguarding against two things, and oftentimes the more costly thing isn't the penalties, even though the penalties could be high. It could be the fact that you're not taking down your credit, you're keeping your reputation with your people that you're paying intact so they can depend on you paying them, and so on, and your credit score reflecting that basically reputation. And then, of course, you have the costs that could be involved. So here's going to be our calculation. Note that this could change from institution to institution, how they're going to implement what their overdraft protection, but this is a general kind of idea of it as we calculate it. So we're going to say we charge for each 100 or portion of 100 borrowed when an overdraft happens at 15%. So we're going to say that there's an overdraft of 530, meaning our account went over by 530. Now, notice what I'm not saying right now is how many transactions it took to go over the 530. We just know that the balance is 530 because that's how we're going to be charged on it. So that would mean that the institution then hopefully still honored those amounts and paid the people that we needed to pay for it, but they're going to tell us there's an overdraft and they're going to charge us that 15%. Now, the way we're wording it here is we're trying to indicate that they're going to charge us 15% per 100. So anything that cuts into the next 100. So in this case, we had 530. We're not rounding down to 500. We're going to round up to 600. That's just going to be the way we're formatting this. So we're going to say, okay, 530 rounds up to 600. We're going to pay basically 15% of the 600. So that would look like this calculation. We'd say, okay, we overdrafted up in increments of 500, 530 rounds up to 600 times the 15%. We're going to then be owing the $90. So that, and if we were in an overdraft situation, we should be fairly happy with that. If they honored the overdraft payments and actually still paid, the bank still paid them, then I'm happy. If it were me, I'd be happy to pay the $90, right? You still paid who I needed to pay. You did I'm happy to pay the $90 if I ran it into the negative. So then we've got the penalty for the overdraft. Now, the other way you might see it, if you don't have overdraft, then we might have a situation, and this is our example situation, assume no overdraft protection and overdraft charges, number of overdraft charges, meaning that they might then charge you by the non-sufficient fund charges that you have, because then they got to process this non-sufficient fund kind of charge every time you try to charge the account. And they might do it on a case-by-case basis and charge you a fairly hefty penalty. We're going to say $45 per transaction here on a case-by-case basis. So not only would they not be paying, possibly, the people that you were trying to pay, not honoring the payment, possibly even having the pain of a bounced check happening, meaning you gave someone a promissory note saying that you had money in the account and you didn't, which greatly lowers the trust of whoever you gave the money to. They got to deal with this bounced check situation. And if it's a situation where you have the credit score, it could lower the credit score. So you have that, and they're going to charge you on a case-by-case basis as well, possibly at a fairly high rate, which oftentimes will be higher than the cost of the overdraft protection. So we're going to say $7 times 45 per charge, which in this case would be $315. The difference between the two being the $225. So that's just an example of how the overdraft could kind of function, and some of the benefits of the overdraft. In general, if you're thinking about a checking account, when you're measuring the options between accounts, I would think you'd want some kind of overdraft protection in there. And the question might be then, what's the cost that I'm paying? So I would assume that you'd say, yes, I want overdraft protection. And then what's the cost of overdraft protection, comparing the different policies from one bank to another bank for that type of protection.